Picture someone who did everything right. They skipped the vacations they couldn't afford. They drove the same car for 10 years. Every month, without fail, they moved money out of their checking account and into their savings account at their bank. The big one, the one with branches everywhere, the one their parents used, the one that felt safe. Over 10 years, they put away $40,000. They checked their balance recently. After a decade of discipline, after 10 years of sacrifice, their savings account had earned them $47 in interest. $47. Meanwhile, the things that $40,000 was supposed to help them buy, a down payment, a car, a cushion, cost 30% more than when they started saving. They didn't fall behind because they spent too much. They fell behind because they did exactly what the bank told them to do. And the bank, the institution that held their money, that used their money, that built a glass tower downtown with their money, paid them $47 for the privilege. That is not a savings account. That is a storage locker for wealth that is quietly evaporating. This is the forensic audit of the savings account scam. I'm going to show you the math they never put in the brochure, the mechanism behind why this happens, who profits from it, and, most importantly, exactly where your money should actually be sitting right now. Let's start with the number that is printed on your savings account statement right now. If your money is sitting in a standard savings account at one of the 4 largest banks in America, JP Morgan Chase, Bank of America, Wells Fargo, or Citibank, your interest rate is almost certainly 0.01% APY, not 1%, not 0.5%, 0.01%. Let's translate that into real money because banks know that percentages are abstract enough that most people don't do the conversion. If you have $10,000 in a Chase savings account at 0.01% APY, you will earn $1 over the course of a full year. $1 on $10,000 for 12 months. If you have $50,000 in that account, one which represents the savings of a responsible, disciplined adult who has been careful with money for years, you will earn $5 a year. Now here is the number they never put next to that 0.01%. Inflation. In 2022, inflation in the United States hit 9.1%, the highest level in 40 years. It has since moderated, but has not returned to the Federal Reserve's 2% target for any sustained period. In practical terms, over the last 4 years, the cumulative purchasing power erosion for a dollar held in cash has been substantial, in the range of 20% or more, depending on what you actually buy. Even in a normal year, at the Fed's own 2% target rate for inflation, your $10,000 loses $200 in purchasing power. Your savings account paid you $1. The net result is a loss of $199 in real value every year, automatically, silently. This is what economists call a negative real interest rate. The real interest rate is the nominal rate, what the bank pays you, minus the inflation rate. When inflation runs higher than your interest rate, the real rate is negative. Your money shrinks while sitting still. The bank is not paying you to save. It is charging you to store your money. And the fee is invisible because it doesn't show up on your statement. It shows up at the grocery store, at the dealership, at the closing table, when the number you saved toward is no longer enough. This is the inflation trap, and it is not an accident. It was engineered. To understand why your bank pays you 0.01%, you have to understand what the bank does with your money after you deposit it. When you put $10,000 into a Chase savings account, that money does not sit in a vault with your name on it. It goes to work for the bank. The bank takes your deposit and uses it as the raw material for loans. Mortgages at 7%, auto loans at 8%, credit cards at 24%, business lines of credit at prime plus 2%. The bank is, at its core, a financial intermediary. It borrows money from depositors at one rate and lends it to borrowers at a higher rate. The difference between those two rates is called the net interest margin. It is the engine of bank profitability, and it is the most important number that your bank never advertises. Let's look at what that margin produced in concrete terms. In 2023, JP Morgan Chase reported net interest income of $89.3 billion in a single year. Net interest income is essentially the profit from the spread between what they pay depositors and what they charge borrowers. Bank of America, $56.9 billion in net interest income in 2023. Wells Fargo, $52.4 billion. These are not their total revenues. This is specifically the money they made on the spread, between the rate they paid you and the rate they charged the person who bought the house down the street. Now ask yourself, if a bank is making $89 billion a year from the gap between your deposit rate and their lending rate, what is their financial incentive to narrow that gap by paying you more? The answer is zero. In fact, the incentive runs the other way. Every fraction of a percent they can hold back from depositors flows directly to the bottom line. Paying you 0.01% instead of 2% on $1 trillion in deposits is worth billions of dollars in additional profit. Per year. Every year. The Wall Street analyst community tracks this metric obsessively. There are entire research teams at investment banks whose job is to model how much profit will increase if deposit rates can be held down relative to lending rates. Your savings account rate is not set by a banker who thought about what's fair for you. It is set by a model that optimizes for shareholder return. That is not a moral judgment. That is just what these institutions are. They are publicly traded corporations with a legal obligation to maximize profit for shareholders. Your retirement security is not their fiduciary responsibility. Your deposit rate is a cost of goods, and they minimize it accordingly. Here's the part of the story that most people miss, because it requires looking backward. This has not always been true. In 1980, a standard savings account at an American bank paid approximately 5.25% APY, capped by what was called Regulation Q, a federal rule that set a maximum interest rate banks could pay depositors. Bankers lobbied to remove that cap, arguing it prevented them from competing for deposits. Congress agreed, deregulated deposit rates, and for a period in the early 1980s, when inflation was in double digits and the Federal Reserve was fighting it aggressively, savings account rates rose to 8%, 9%, even above 10% at some institutions. Your savings account used to work for you the way a bond works. It was a genuine store of value that generated real returns above inflation. Then came 2008. In response to the financial crisis, the Federal Reserve cut the federal funds rate, the benchmark rate that drives all other interest rates in the economy, to essentially zero, near 0%. Where it stayed, with minor fluctuations, for the better part of 14 years. The stated purpose was to stimulate economic growth by making borrowing cheap. And it did stimulate borrowing. Corporations borrowed cheaply to buy back their own stock. Private equity firms borrowed cheaply to buy up apartment buildings and single-family homes. Asset prices inflated. What it also did, by design, was eliminate any meaningful return on savings. The Federal Reserve's own research has documented that persistently near zero interest rates transfer wealth from savers to borrowers. Savers, who tend to be older, working class, and middle class, had their returns confiscated by policy. Borrowers, who tend to be institutions with access to capital markets, received an enormous subsidy. But here's the detail that reveals the true anatomy of the trap. When the Federal Reserve raised rates aggressively beginning in 2022, the fastest rate hiking cycle in 40 years, pushing the federal funds rate to over 5% by 2023. Lending rates responded immediately. Mortgage rates doubled in 18 months. Auto loan rates climbed within weeks. Credit card rates hit all-time highs. The big banks passed every single rate increase directly to borrowers. They did not pass them to depositors. During the same period that the Federal Reserve raised rates by more than 5 percentage points, Chase's standard savings account rate moved from 0.01% to approximately 0.01%, not a typo, the same rate. The Federal Reserve's own data released in 2023 showed that the 4 largest U.S. banks were paying depositors an average of 0.23%, while the federal funds rate sat above 5%. The spread between what large banks paid depositors and the overnight risk-free rate was at one of its widest points in modern banking history. The banks passed every rate increase to people who borrowed money from them. They passed almost none of it to people who lent money to them, which is what you do when you make a deposit. This is the mechanism. It is not subtle and it is not hidden, except by the sheer complexity of the financial system that discourages most people from ever doing the arithmetic. The large banks hold over $7 trillion in retail deposits. At the gap between what they pay and what they could pay, the daily wealth transfer from American savers to bank shareholders runs into the hundreds of millions of dollars every single day. Your savings account is not a savings product. It is a deposit vehicle that benefits the institution holding your money far more than it benefits you. Now let's talk about the loopholes. Because unlike some of the other corporate traps we expose on this channel, this one has real exits. They are not complicated, they are not risky. The financial industry simply relies on your inertia and your trust to keep you from using them. Option 1, high-yield savings accounts at online banks. When the Federal Reserve raised rates beginning in 2022, online banks, institutions without the branch infrastructure and overhead costs of the major banks, began offering savings rates that tracked the actual federal funds rate. At the peak, institutions like Marcus by Goldman Sachs, Ally Bank, American Express National Bank, and several others were offering 4.5% to 5.3% APY on standard FDIC-insured savings accounts. These are not exotic financial products. They are savings accounts. They carry the exact same FDIC insurance as your Chase account, up to $250,000 per depositor, per institution. They function identically. The only difference is the rate, which at their peak was literally 500 times higher than what the major banks were paying. The reason Chase can pay 0.01% while Ally pays 4.5% in the same rate environment is not that one is safer or more sophisticated. It is that Chase has $3.7 trillion in deposits from customers who never switch, which means Chase does not need to compete for deposits with higher rates. Online banks have to earn your deposit. Major banks know you won't leave. Your inertia is their pricing power. The math on switching is not academic. On a $25,000 deposit, the difference between 0.01% and 4.5% APY is roughly $1,125 per year. That is not a rounding error. That is a car payment. That is a month's groceries. That is real money that is sitting in Jamie Dimon's net interest income column instead of your account, because the transfer takes about 15 minutes and most people never make it. Option 2, U.S. Treasury bills and Treasury Direct. If you want to hold cash at the risk-free rate, meaning you want whatever the U.S. government is currently paying on short-term debt, you can buy Treasury bills directly through treasurydirect.gov. No broker, no bank, no intermediary taking a spread. Treasury bills are short-term government debt instruments, 4-week, 8-week, 13-week, 26-week, and 52-week maturities. During the 2022 to 2024 rate environment, 3-month T-bills were yielding above 5%. They are backed by the full faith and credit of the U.S. government, which makes them, in the technical definition, the safest financial instrument that exists in dollar terms. The process of buying them is less intuitive than opening a bank account, which is precisely why the financial industry never explains it to you. It is, however, not complicated once you've done it once. Treasurydirect.gov is a federal government website that allows any American to purchase Treasury securities with no fees, no commission, and no minimum beyond $100. Option 3, Series 1, Savings Bonds. Treasury I-Bonds are a specific type of U.S. savings bond with an interest rate that is tied directly to the consumer price index, meaning the inflation rate. When inflation runs high, I-bond rates run high. When inflation ran at 9.1% in 2022, the I-bond rate was 9.62% for a federally guaranteed savings instrument with no credit risk. I-bonds have purchase limits, $10,000 per person per year through Treasury Direct, a 1-year minimum holding period, and a 3-month interest penalty if redeemed before 5 years. These constraints make them unsuitable as a complete savings solution. But as the inflation-protected portion of a cash savings strategy, they are one of the few products in existence that is mathematically designed to ensure your savings keep pace with the actual cost of living. The one thing your bank account was supposed to do but structurally cannot. Option 4, Credit Union Money Market Accounts. Credit unions are member-owned, not-for-profit financial cooperatives. They do not have shareholders to pay. Profits are returned to members in the form of higher deposit rates, lower loan rates, and reduced fees. The structural incentive that drives a publicly traded bank to minimize what it pays depositors does not exist at a credit union. The National Credit Union Administration insures deposits at federally chartered credit unions up to $250,000, the exact equivalent of FDIC insurance at commercial banks. The money is equally safe. Credit union money market accounts, which are savings-adjacent accounts with slightly higher balance requirements, have historically paid meaningfully higher rates than comparable products at major commercial banks. In the current rate environment, well-run credit unions have offered money market rates competitive with or exceeding what online banks pay. To find a credit union you're eligible to join, the website mycreditunion.gov, run by the federal government, allows you to search by location, employer, or community membership. The common bond requirements for joining most credit unions have expanded significantly over the last 2 decades. The majority of Americans are eligible for at least one well-rated credit union they don't know about. Here's the bottom line. The savings account at your major bank is not a savings tool. It is a deposit relationship that is enormously profitable for the bank and marginally useful to you. The gap between what that bank pays you and what you could be earning in an FDIC-insured account at no additional risk with a 15-minute transfer represents one of the largest quiet wealth transfers in American economic life. They count on the fact that switching feels complicated, that the rate sounds too small to matter, that moving your emergency fund to an online bank you haven't heard of feels risky, even though the federal government insures it identically to your Chase account. They count on your trust and your inertia, both of which, if you've watched this video, you should be reconsidering. This is not about getting rich from your savings account. Savings accounts are not investment vehicles. They are where you park money you might need, your emergency fund, your near-term goal money, your operating buffer. The question is whether that money, while it sits there serving that function, loses 2 to 3% of its value every year or roughly holds its own. The answer to that question is currently worth hundreds of dollars a year to the average household. Over a decade, it is worth tens of thousands. Not from speculation, not from risk, just from choosing a different institution to hold the same money. The bank is not your savings partner. It is a business that found a way to use your conservatism and your trust against you. The antidote is information. You now have it. Before you go, I want to know your story. Drop it in the comments below. What bank are you currently at? How long have you been there? And have you ever actually looked at what your savings rate is? I want to see the range, because I suspect most of you have never had this conversation with your own account balance. If this audit was useful, subscribe. Every couple days, I examine the systems that are quietly draining American households, not through dramatic fraud, but through the design complexity and institutional inertia that makes most people never ask the right questions. The next audit is already in the making. I'll see you there.